Good afternoon, possibly good morning to you, wherever you're listening to us from today. Welcome to another great educational webinar here we have at Advanta IRA. Excited to bring on our guest speaker in a few minutes here today and talking about really a different aspect of oil and gas investing. We have had another guest or two from time to time discuss this topic, but this is the first time I think we're talking specifically about the royalties and actually getting a deed to a property and then having earning income for your IRA or maybe personally if you're doing this not inside an IRA, but actually owning a deed to the asset. So again, if you're listening to us live, welcome. If you have any questions during the webinar, get those typed into the question box on your screen, whether it's a question for myself or our guest presenter today. Put the question in the question box. We'll make sure we get it answered at some point during the 45 minutes to an hour or so webinar that we have today. Just a quick bit about myself. My name is Scott Maurer. I'm the Vice President of Sales here at Advanta IRA. Been with the company for a number of years now. My degree, my background is I am a licensed attorney. I don't do any legal work for Advanta clients, but I do help people really figure out what it is that they want to do with their IRA account, help to assist them with getting the paperwork and the process started. And been doing it for a long time, so always happy to address any questions people have about general IRA, 401k type questions, and then more specifically about the self-directed aspect. My contact information is on the screen. Like I said, if you have questions during the webinar, please don't hesitate to put those in the question box. We'll make sure that we get to them. Just a little bit of housekeeping. All of our webinars, we always like to put this disclaimer out there that Advanta and its employees, we don't provide investment advice, and we also don't endorse any product or investment. We bring information, we bring these webinars to you to really help educate you, just open up your mind to different potential investments. But whenever you're looking to make an investment, make sure to do your due diligence on those investments, on the people that you're dealing with as well. If you need outside counsel, we always can give you the name of a CPA, an attorney, maybe a financial advisor who can give you some better guidance when it comes to your IRA account or the investments that you're looking at making inside of that IRA. Now, if you're new to self-directed IRAs, you're new to Advanta, just a quick basic rundown of our company, and we'll go into a little bit about self-direction as well. We are a nationwide self-directed IRA administrator. We've been around for almost 20 years. We have over $2.7 billion in assets under management, a combination of a variety of different types of assets that we hold and administer on behalf of our clients and their IRA accounts. We do try to set ourselves apart in the industry. We really focus on the education aspects of educating our clients and bringing great content and things to the forefront, whether it's the webinar like you're listening to today or one of our other events that we do. And we also give our clients a dedicated account manager, a one-on-one contact for the investments, anything else that they need within their particular IRA account. So you'll get that personal touch from us when it comes to handling and holding your IRA accounts. Again, our learning center webinars, we have 1 to 2 webinars per week. We also do live events in local communities. We do private events if you're someone looking for a speaker for your event, whether it's an online group or it's an in-person group, or it might be possible for us to get myself or one of my colleagues to come out and speak with you about self-directed IRAs and present to your group. So please reach out to us for that. Like all webinars, this webinar is being recorded, and the recording will be placed on our video library. We have a very extensive YouTube video library with all of the recorded webinars that we do, usually placed up on the page within a day or so of the live events. If you ever miss an event, or if you see an event that you would like to attend but just doesn't fit your schedule, sign up for the webinar anyway. You'll get a link to that recording after the fact. Now, just a little bit about self-directed IRA accounts. It's important to note that the word self-direction is really more of a marketing term, really, if anything, and really describing more of the ability for you to use your IRA funds to invest in a wide variety of different types of assets. But at their core, a self-directed IRA is still either a traditional or a Roth IRA. It could be a SEP or a simple IRA if you're a small business owner. So the contribution rules, the distribution rules are exactly the same for these types of accounts as they would be if you had a traditional IRA at a brokerage firm. So you're still limited to the same annual contribution limit with these accounts, whether it's a self-directed account or a brokerage account, and you're going to be subject to the same distribution and taxation rules for those accounts as well. The difference is really what you can place your funds into as an investment. So you have cash within your IRA. You need to have that money invested somewhere. With a brokerage firm, they're going to limit you to what they sell, which is going to typically be a publicly traded mutual fund or a stock or some other type of security. With a self-directed IRA, your options are almost limitless. And I say almost because the IRS does not allow you to invest in life insurance products or things that are deemed a collectible, like antiques or artwork or things of that nature. But outside of that, you can use any of these types of IRAs. You can use any former employer's plan. If you have an old 401k or an old 403b, maybe an old TSP plan. If you have one of those former plans, you can also self-direct the money within those accounts as well. Now, when it comes to identifying an investment, you find a piece of real estate, you want to invest in an alternative asset that you need a self-directed account for. You would fund your self-directed IRA typically by moving funds from an existing retirement account that you may have with a bank or a brokerage firm. If it is an IRA account, you would move the money via what's called a transfer, which is a trustee to trustee movement of funds from that one IRA to the other. It's a non-taxable event. The money doesn't touch your hands, and you can do transfers as often as you'd like. And there's also if you have money in an old 401k or one of those old employer plans, it's not a transfer, but it is considered to be a direct rollover. Those are kind of industry-specific terms. Direct rollover is moving money from an old employer's plan over into an IRA account. So it's kind of how the process goes depends on what type of an account that you have with your other firm. And certainly myself and my colleagues here at Advanta IRA, happy to walk you through what's needed when you're looking to fund your account. Who do you contact? What paperwork do you fill out? And moving the money over takes anywhere from a few days to a few weeks. It just depends on the other custodian, and it depends on what type of an account that you have, whether it is another IRA or whether it is one of those former employer plans. So getting started, fairly simple. It's filling out the right paperwork. And again, we're going to walk you through that process to let you know how that will work. And when it comes to then self-directing, we're not going to obviously cover all the different types of assets today. We're focusing on one specific, not only asset class, but specific investment. But we focus a lot on our webinars on real estate assets because probably 70 to 75% of the assets that we hold at Advanta IRA for our clients and their retirement accounts are in the real estate realm. It's people buying rental properties, maybe by investing in commercial real estate, doing a rehab or fixer-upper property, investing in real estate syndications and raw land. Again, so a lot of our webinars are then geared towards that subject. And typically, I think in the past, like I said, we've done some oil and gas talks, but it's been more about oil and gas bonds or different types of funds you can invest in, not necessarily getting the actual deed to the property, which is, again, what I think is unique about our speaker today, and we're happy to have him join us in just a moment or two, talking about buying mineral rights deeds, where it's not just investing with a company, it's actually investing in getting a deed and having your IRA own title to part of the property itself, where the royalties are going to be realized from. So I'll have our guest speaker come on just a minute to describe that. But again, your investment options are, like I said, almost limitless. You just can't invest in life insurance and collectibles. Again, today we're focusing on mineral rights deeds. Now, when you are buying property and you're getting a deed to a property, whether it's a mineral rights deed, whether it's a regular warranty or quitclaim deed, if you're buying through your IRA, it's important that the deed that's being purchased is done in the name and is issued in the name of the IRA account. So if John Smith was using his IRA to buy a mineral rights deed, the actual deed should be titled as Advanta IRA, FBO, or for benefit of John Smith's IRA and his account number. That demonstrates to the IRS that this is an asset owned by his IRA account, and all of the income that is generated will flow back to his IRA, not to John personally. So this is keeping the investment, keeping all the future gains, all the royalties, tax protected inside of his IRA. So John Smith, instead of having his money in the stock market, is choosing to invest in a mineral rights deed and receive the royalties from those mineral rights back to his IRA. That is how he is going to grow his retirement account. In this particular case, all the funds for the purchase come from his IRA account, so it's just John Smith's IRA by itself making the purchase. It is possible when you're investing in real estate and you're getting deeds and other assets for that matter, you also purchase alongside partners where it's your IRA. Like I said, John could purchase with part of his IRA, maybe part of his spouse's IRA funds, if that was the case, or maybe his brother's IRA, and then split the income and expenses proportionally. So again, when your IRA makes this type of an investment, all of the income goes back to your IRA account. If there are any expenses, property taxes, other maintenance items, if you're buying, say, a rental property, those expenses would need to be paid out of the IRA as well. That's what we manage at Advanta. That's our role as a record keeper, to manage the income coming in, pay the expenses going out, and take care of all of the IRS reporting as well. So without further ado, I would like to introduce our guest presenter today, Jonathan Flores. He is the founder and CEO of Guardian Royalties. They offer the acquisition and the offering of oil and gas royalty properties.
I'm doing well. How are you doing, Scott?
Good, great. Yeah, I could see your slides coming up right here on the forefront. Everybody else should be able to see it. Like I said, before I have you introduce yourself and give a little more details and get into the presentation, again, I want to encourage everyone who has a question to get those typed into the question box. We already had one come in that said, I've heard of investing in oil and gas royalties before. Does that always refer to what we're discussing today? And are there other ways to invest in royalties? Someone said like the bonds you mentioned. So there are maybe different ways, and that's, I think, I'm going to just put that question out there. I'll let it lie. Jonathan, I'll let you take over the presentation, and kind of, I'm sure you're going to answer those questions at some point during the presentation. If not, we'll circle back to it. But thanks for joining us today. Looking forward to your content.
Certainly. Well, it's a pleasure being with you, Scott, and a pleasure addressing all of you that are tuned in today with us. I am in cloudy Dallas, Texas this morning, and excited to share with you what we do here at Guardian Royalties, and just a little bit more about royalties and how they work in the oil and gas world. Royalties is a big term. Can mean a lot of different things. You can get a royalty check from music rights. I had an investor recently I was talking to who invests in music rights, or sometimes in movie rights, or various avenues. And so I wanted to just bring some clarity. One of the things I want to do is to bring some clarity as to the definition of what that is. Even in the oil and gas space, there are multiple ways that a royalty can be defined. And so I want to just go over that a little bit. At the basis of what we do is we actually sell the royalty deeds. You can actually purchase the deed that's registered at the county courthouse in your name, just like the deed to a physical property. But rather than having the surface rights of the property, you own everything subsurface. And so it's essentially a real estate transaction in the ownership of subsurface rights or subsurface acreage. This has been going on in Texas from the beginning of our statehood. In 1866, our state actually put in the Constitution the rights to own mineral rights. And so for the last 140 years or so, then individuals in Texas have been trading mineral rights where that can be severed from the physical property. Individuals would sell a piece of land, but maybe there's an oil well producing on the land that they're getting revenue from, and they want to maintain that monthly income that they're getting from that oil well that's on their property. And so they sell the land, but sever the mineral rights from the sale of that physical property. And so what they do in that instance is they maintain what we call the mineral deed on that land. And so I want to get into a little bit of how that works and the various ways that can be done. As Scott said, my name's Jonathan Flores. I have worked in this arena in mineral deeds and various types of oil and gas royalties for well over a decade. Have seen a lot of properties come and go. I've seen properties that perform well for the buyers. I've seen properties that have performed poorly for the buyers. And so over the years, we've been able, because of the experience that I have and the team that we have on staff and people that we partner with in our company, we've been able to really hone in on what it is that makes a great royalty property and those things you want to look for those individuals who are considering the purchase of a royalty property. And so I want to move first of all here to what are the benefits of oil and gas royalties. Well, first of all, monthly cash flow. Various investment types pay in a number of different ways. Whenever you own the mineral deed directly on a property, then the operator of the wells on that property are going to pay you a monthly check based on the production of that property. And so a lot of people who buy this kind of thing are retirees who want another form of monthly income. Also, we've got individuals who are planning for retirement and want to see a stronger return rate than what they might typically see in the stock market or in traditional funds or things of that nature. It's an alternative investment that can generally bring a stronger return rate than what you would see in those various avenues. And then also sometimes small business owners or farmers who need another form of dependable monthly income. And so royalties always pay on a monthly basis. Another reason people invest in this kind of thing, another benefit, is tax sheltered income. We all want to keep as much money as we can that we make. Similar to in real estate, where you get what they call a depreciation allowance. Most people are familiar with that. You get it on your home or any kind of physical brick and mortar real estate that you own. In oil and gas, we get what's called a depletion allowance. And what that means is that 15% of the revenue that you receive on an annual basis when taxed, you're only taxed on 85% of the revenue that you receive. 15% of your revenue is completely tax-free, and that's where the tax shelter comes in royalties. One question that I sometimes get for people who are familiar with investing in oil and gas is the investment deductible? Because some people may have some experience investing in oil and gas drilling programs. And in royalties, we're not able to deduct the investment that is made because we aren't taking on the risk of drilling. We already have established oil and gas wells operating on the property. And so the tax shelter we get is the shelter on the income received, with 15% of it being completely tax-free. This is a long-term passive income strategy where the properties that we sell, and I want to say this isn't always necessarily true of all oil and gas royalty properties, but again, due to our experience and the properties that we source for our clients, then you can ensure long-term income. Most of these properties will perform for decades for the investor at some level. This is a passive activity, which I know is very important to a lot of investors, non-manageable and passive when it comes to tax treatment. And then the fourth thing listed here, asset value appreciation potential. One of the things that a lot of people think is that when these wells go dry, once they're depleted, that there's no longer any cash flow being generated, therefore the deed that they have, the mineral deed on the land, is of no value, when that simply is not always the case. Again, it's going to depend on the area that you're in. There are things to look for to know that you have a deed that is going to have inherent value for decades to come. And that's one of the things that we do in our due diligence process, is we want to know that we've got a deed that's going to have value for a long time. And I'll go in a little bit later to some of the things that give that deed value, but that's one thing that you can count on when looking at properties with our company. Moving on to what is an oil and gas royalty. There are three different ways it's defined. You see here, mineral interest, non-producing, royalty interest, producing, and overriding royalty interest. When you have a mineral interest, generally that is when you own the deed. You own the deed to a land and there is no production, there are no wells, but you own the mineral rights or the mineral deed to the property, you have a mineral interest. That is simply how that is defined. Now, when it becomes a royalty interest is when an operator acquires the lease to the property and then begins generating production. Once production is generated, at that point, it becomes a royalty interest because now there is a royalty to be paid. And I want to get in next to how that really is differing from an overriding royalty interest. This is an area that needs much clarification because a lot of companies will sell oil and gas royalties, but they're not selling you the deed. They're selling an override or an overriding royalty interest. The difference between that and actually owning the deed is this. Overrides are originated 99% of the time by the operator, where an operator of wells will shave off a portion of their revenue and say, I'll give you 1% of the revenue generated by this well for X amount of money. They give it some dollar valuation. The reason that we do not sell overrides, we sell only actual mineral deeds, is because overrides can be terminated under multiple circumstances. If the operator of that property were to go defunct, let's say, or if for any reason that lease is defaulted, then your investment is dead because an override is tied to either the lease or particular wells, but either way, it is generated and originated by the operator. The difference being when you own the mineral deed, just as if you had bought the physical land, you own that in perpetuity. And so it does not matter who is operating the wells. It does not matter what company is there, what companies come and go. You hold that deed, as I mentioned before, registered at the county level in your name. You hold that in perpetuity. And so come or go, whoever is working on the property has to pay you a royalty on any production generated on the property. And so you've got a lot more security when owning a mineral deed rather than having simply an override or an overriding royalty interest. Another difference is that overrides can sometimes be structured in a way that you are paid on the net revenue after the operator of the wells has paid their monthly operating costs for those wells. As a mineral deed holder, because we own the minerals on the property, we have no direct relationship with the operator or no direct connection to the wells. Because they're simply on our land, we are paid on the gross of the revenue generated on the land. We're not responsible for any operating. We have no relationship with the operator. And so because of that, the royalty they have to pay us is paid on the gross of the revenue generated on the property. Whereas with an override, you are sometimes paid on the net after their operating costs. And so for these reasons that I've mentioned, that is why we prefer to deal primarily with mineral deeds. It is a safer function in the long run and generates more revenue for you, given that we are paid on the gross of what is produced. Moving on to the next slide, here are the frequent questions that we get as a royalty company. Do I have liabilities regarding the oil and gas production? As I just mentioned, we have zero liabilities connected, not only in regard to cost, as I previously mentioned, but also in regard to accidents or incidentals. One of the fears that many people have when getting involved in oil and gas investing is, what if there is an oil spill? What if there are a number of things that could happen? What if a worker is injured during the development and drilling of the wells on the property? Do I have any liabilities related to any of these kinds of incidents? And the simple answer is no. As a mineral deed holder, I mentioned a moment ago, we have no connection or relationship whatsoever to the operations on the property, to the operator on the property. They are simply on our land doing work on their own. Our sole position in all of this as a mineral deed owner is to receive a royalty from the revenue that they generate. All liabilities fall on the operator. No matter what it might be, we are completely sheltered because we have no relationship whatsoever to operations taking place on the property. The next question there, do I only get royalties for wells that are on my respective acreage? This is a common question that we get because the areas that we sell mineral deeds to are large acreage positions, generally at least 140 acres, which is required by the state of Texas to drill a deep horizontal well. They have to be at least that number of acreage, but sometimes the properties that we sell could cover multiple thousands of acres. So if your deed then is tied to a particular acre in the corner, then the question I often get is, what if the drill takes place on an acre that's 600 acres away? What happens whenever an operator wants to come and drill a deep horizontal well whose lateral legs, horizontal legs can be 2 miles, 3 miles long, sometimes more, is you're crossing a lot of property. And so the reason the state requires that they acquire at least 640 acres in order to drill this kind of property is because in doing so, it ensures that they have all of the acreage that their lateral leg will extend through. And then once they do that, then all mineral acres across the entirety of what then they call a unit, all mineral owners across the entire 640 acre unit share in a pooled interest. So if your minerals are tied to a particular acre in this corner, the wells that you receive royalties on do not have to be drilled on your particular acre. Anything that takes place across the entirety of the unit, you share in that revenue. And so regardless of where the well is located, where it's drilled, because your acreage is within this 640 acre unit, which is the minimum required for them to drill these types of wells, you share in that revenue. And so the answer to that is no, the well does not have to be on your particular acre. But once multiple acres and leases are unitized and the unit is created, then all mineral owners, anyone who holds a mineral deed across any of those 640 acres, share in a pooled interest. The next question that we often get, does any amount of money come from my revenue? As I mentioned before, there are no costs that we are responsible for. The responsibility of taking care of operating costs on a monthly basis for electric or water or whatever they might need to operate the wells is fully the responsibility of the operator. The only thing that comes from your revenue is a severance tax applied by the state, which obviously is minimal, relatively minimal. Generally could be 4 to 6% of your revenue on a monthly basis. There is nothing else that comes from it. Additionally, a lot of royalty companies will charge an administrative fee for the management and distribution of your revenue and statements on a monthly basis. We have structured things differently here. As the CEO and founder of Guardian, one of the things that I do to protect our clients and to ensure that they receive as much revenue as possible that they're entitled to is we file your deed directly with the operator of the wells on the property. And what that does for the investor is it allows for the checks to go directly from the operator of the wells on your land to you. There is no middleman. And so there's no administrative fee that our company or anyone deducts from your revenue on a monthly basis. But every dollar that you're entitled to from the land goes directly to you from the operator. Talking about finances and revenue, I also want to touch on this as it's a question I often get. How is this revenue reported and how do I get documentation? The operating company will provide statements to you on a monthly basis along with your revenue. But in addition to that, every year at tax time, you'll receive a 1099 for the revenue received from the operator directly. And so you can see how that there is, as I mentioned before, no middleman in this process. All revenue, all documentation comes directly from the operator of the wells on your property to you. To simplify things, it makes things better for you. It makes things better for all parties involved. The less people that are involved, ensuring you get as much money as possible. The other question I have here, what are the risks of purchasing royalties? Obviously, with any investment, there are any risks. And so I want to talk about this. Our revenue on a monthly basis is based on two factors. Number one, how much oil and or gas are being generated on a monthly basis. How much production are we seeing? That's going to be the first factor. The second factor being, what do we sell that oil and gas for? What dollar amount does the operator sell that for? The operator sells the oil and gas for the average market price of oil and gas for that given month. Obviously, oil and gas is a cyclical market. It's going to go up, it's going to go down. And so whatever the price of oil and gas are on the market for that month is what our production is going to be sold for. And so we do a number of things to hedge our risks whenever we're doing due diligence on a property. We want to look at the location, just like with physical real estate. Location is one of the most important things that you need to consider. I often say that I'd rather have an office tower in downtown New York City rather than in Boise, Idaho. Obviously, New York is a hub of business and business activity. And so there is a greater security that you're always going to have tenants in a building like that. The same goes for looking at mineral rights. We are solely focused as a company in buying and selling mineral rights and mineral properties in the Permian Basin. For anyone who has followed oil at any level for any amount of time, you're likely familiar with the fact that the Permian Basin is the largest oil field in North America onshore and one of the largest in the world. Because of this, you've got every operator that is known, all major operators, Shell, Chevron, Exxon, you name it, operating in this area. One of the other reasons that they operate here is because it's a very expensive area to drill deep horizontal wells. Number of years ago, greater than a decade ago, probably 2010, give or take, some new discoveries were made in the Permian Basin where People thought that it was old and depleted, that it had seen its day. But due to the advent of horizontal drilling and hydraulic fracturing, we were able to discover and then exploit deep shale formations that were previously unknown and unable to produce from. So the Permian Basin has seen a resurgence in activity. It is one of the most active areas in the country. Because of developing technology in the Permian Basin, then there is work that can be done for decades to come. Whenever you look at a property and they're developing wells at a particular depth interval, then one thing that can be said is that in the Permian, oil and gas bearing formations are layered one on top of another, similar to looking at a layered cake where you have multiple layers separated by icing or however it may be. You can look at a geological map of the Permian Basin and see multiple layers of geological formations that all contain oil and gas hydrocarbons. And so it could take decades for them to develop the particular formation that they are developing. But then when they're finished developing from that formation, they can drill to another depth interval and then begin depleting from that formation. And this can take place over and over again, giving us security in this area. Again, location being of absolute key when you're wanting to secure long-term cash flow. Then you want to be in an area where you know there is opportunity for continued development for years and years and decades to come. And so one of the things that we look at, in addition to that, it is relatively inexpensive to drill or to, let me rephrase that, to produce and sell oil from the Permian Basin. Although the wells are expensive, the transportation infrastructure for selling your oil and gas is incredibly well developed in the Permian Basin, because the Permian Basin has been active for oil development for over a century. We are relatively close to the refineries that are on the coast of Texas. Then our transportation infrastructure, pipelines and so on, are very well developed. And so we get very close to top dollar for the oil and gas that are produced. And to give a little bit of a greater explanation there, back in 2013, 14, when the bottom of the oil market completely fell out, then there was a formation in North Dakota. It covers a couple of states up there. North Dakota was the primary area that was being developed, a formation called the Bakken Shale in the Bakken field. The Bakken Shale produced great wells, huge oil wells. The problem was it was such a new area to develop that they didn't see great revenue from those wells because transportation was so expensive in that area that they were getting around $15 a barrel under market price because their transportation was so expensive to truck all of this oil out for many, many miles to the nearest rail yard or refinery. However, because we have such developed transportation infrastructure in the Permian Basin area, then we are able to get top dollar for the oil and gas that we sell because it's incredibly inexpensive to get that oil to market, which many people don't consider that aspect when looking at oil and gas pricing, considering an investment, but it's something that is of absolute importance. And I would say there is no better place in our nation to invest in any kind of oil and gas investment than the Permian Basin. And so we focus on this area. I'll give one more example. I've been talking for a while now, and I know we want to open this up to some questions, but we had a gentleman who invested with a previous company, a gentleman who I worked with had a client who over his lifetime had put roughly $10 million into buying oil and gas mineral rights over his lifetime. For these many years, he enjoyed the benefit of the monthly revenue that all of these properties he'd invested in were bringing to him. Upon his death, his heirs were offered $19 million for his royalty portfolio. And so this goes to prove several of the things that I've mentioned. It disproves the idea that the assets themselves carry no inherent value in the long term. Obviously, he'd paid not $10 million for these assets along the course of his life, and for those assets themselves was being then offered $19 million. His estate was offered $19 million for these assets because of the areas that they were in. They had inherent value, and the continuing development of technology to extract oil and gas is one thing that continues to add value to these deeds and these assets in the long term. But not only did the assets themselves almost double in value, but all along the way, for those decades of his life, he was enjoying the monthly income. And so location is the thing you really have to look at whenever buying. So going back to the question, what are the risks? Getting in a bad location in an area where wells are going to deplete and there's no work that can be done to them is one of the greatest risks. Another risk is the price of oil going down to zero. If we can't sell our oil for anything, it's not going to generate any revenue for any parties involved. We saw that briefly take place at the beginning of the coronavirus pandemic, where those of you who follow markets may remember that we saw oil go down to actually negative zero. I think it went to a negative $30 a barrel futures perspective. Only lasted, a single day on the markets. It began coming back, but that is another risk, is the fluctuating prices. And then obviously the other risk being having no production, which again, I'll tie back to the conversation about location. If you shore up your location well, then you can ensure that there will always be development on the property on which you are developing. So those are the highlights. Those are some of the most often asked questions that we get. That's really what a royalty is and how that it functions. And so at this point, Scott, I'll turn it back over to you, and we can take some questions if anyone has any.
Yeah, no, we had, Jonathan, thanks. Great information. We had a number of questions come in during while you were speaking. I was going to interrupt you at some point, but you were doing a great job just rolling through it, so I just kind of let it go. We had a couple people ask us at the very beginning, you were talking about that some of the income that is generated is set aside as tax-free income, and how that interplays with the IRA. So on one thing, I'll just answer off the top. If you are investing through your IRA, the income coming back is tax-free anyway back to the IRA account. Now, if it's a traditional or Roth, your taxation will depend on when you pull that money out later on in life. But from the investment side, the income comes back to the IRA with no tax consequence. One of the questions says, do you not have to pay tax then when you withdraw that 15% from the IRA? And unfortunately, that's not how that works with the IRA. You would, if you have a traditional IRA account, when you pull that money out in retirement, it's all taxed. It's taxed you at that time. So there is no basis or set aside for that. But I guess the question, Jonathan, going back to someone said, what is the reason only 15% of the income is then tax free?
It's called a depletion allowance. And you can, as I mentioned before, you can relate this back to a depreciation allowance in real estate. You receive that depreciation allowance because the property, all physical property, is going to depreciate over time, as far as the quality of the brick and mortar property, if you will. And so the concept is similar here, that where what we call it is not a depreciation allowance, but we call it a depletion allowance. And we are afforded that because oil and gas wells obviously are depleting over time. One of the things, this is a great question because it leads to something that I did not mention that we shore up whenever we are doing our due diligence on properties that we purchase, is that we always want to know that there is room for more wells on a property that we're buying. We're buying a mineral deed. We want to know that we don't just have these wells that are currently producing, but because they're depleting. Again, to answer your question, it's a depleting asset, an oil well. And so that's why we get the allowance. However, we don't want to depend on just the wells that are coming. And the state, every state, oil and gas laws vary by state, but every state has what we call spacing requirements. And so there are a limited number of wells that can be put on a property because of the spacing requirements by the state. And so we always look at the size of the property, the number of wells on the property, and then the spacing requirements to know how many more wells can be put on the property. And does the operator have plan to drill more wells? That's all going to vary depending on the property you're looking at. And if anyone has further questions about that, we can look at that in particular case studies. For anyone who has, wants to dive real deep into some of those details, I'm happy to have a conversation about that at a later time. I'll provide my contact information in a moment. But that's why we get the depletion allowance. It's because oil and gas wells obviously are depleting. So similar to how brick and mortar property is depreciating, you get the depreciation allowance. Because oil and gas wells are depleting, we get that depletion allowance. Does that make sense, Scott?
Yeah, no, great answer to the question. And following up on that, right in the same vein, someone asked, do royalty deeds have bonus depreciation similar to other real estate investments? I'm going to guess they don't. It's the depletion allowance that is given it as instead of any type of other depreciation.
Yeah, that's correct. You're correct in that. We do not get bonus depreciation because bonus depreciation is a tax category that is applied to hard assets, physical assets. And because all of our rights are subsurface, there are no physical assets that we have rights to. Again, if you were investing in the drilling of a well, we call that working interest. You're investing in a particular well and taking on the risk of drilling that well, hoping you don't get a dry hole. Then if you're investing in a physical well, you do have physical assets like the pump and the motor and things like that you can depreciate under bonus depreciation law. But because we have no physical assets, then we don't, none of what we do in owning the subsurface rights is applicable for bonus depreciation.
Gotcha. Good. And next question, someone says, when an operator defaults, how can the investor recoup their initial investment and the royalties if the operator defaults?
Yeah, if an operator defaults, there's not a lot we can do about that as mineral holders. We're in a completely passive perspective here. We're in a completely passive position, rather. And so that's why we only buy mineral deeds in the most coveted areas to operate. Because if by chance an operator were to default on the lease and leave the property, we want to know that someone else will come in, that it's a desirable and coveted property for operating companies. I'll say this too, because of the areas where we buy minerals and it is so coveted, I have never seen a property in this area where we have activity. I've never seen a property lack activity, because generally we have large public companies, as I mentioned before, Exxon, Chevron, companies like this who are operating. You have a lot of security whenever you know you've got an operator like that on your property drilling the wells. Now, that lease could change hands where, and just a quick example of that, whenever Chesapeake, massive public company out of Oklahoma City, went bankrupt many years ago, decade or so ago, maybe not quite that long ago, then all of the leases that they held, they didn't simply default. They sold them to other operating companies. And so for anyone who understands business, M&A type things or bankruptcy to it at any level, you know these companies are going to do whatever they can to capitalize their assets. And so in an area like this that is highly valuable and wildly coveted in the areas that we buy mineral rights anyways, then there's a lot of security there that you've got very large, mostly public companies who hold these leases, and they're not just going to let them go, because these leases, they can pay as much as $30,000 to $50,000 an acre simply to acquire the lease. You're looking at multiple millions of dollars for them simply to acquire the lease. And so if they're having some kind of difficult position as a company, they'll not default in a situation like we could potentially see on the properties that we buy, but they're going to capitalize that. And that's why we focus on the properties and locations that we do, with making sure that we've got these kinds of operators on the property, because it hedges us from things like that. If you're in a more obscure area, I'm not saying that buying a royalty in a more obscure field is always bad. You can sometimes find good deals there, but you don't have the security that we do in the areas that we're in and with the operators that we have.
Very good, Jonathan. If you want, make sure you get your slide up with your information on there for people to see. Because we still have a number of questions. I don't know if we're going to have time for all of them. I want to go through maybe a little bit more, somewhat rapid fire with a couple of them. But
Scott, can you see this slide okay, or is my screen in the way?
No, I can. Yep, we can see it very clearly. Yep.
Yeah, here's all of my contact information for anyone who has further questions or interest.
Yep. One question was come back when you're talking about the restructuring or doing the things different with properties. I guess a concern someone said, if there was restructuring involved with the operations or whatever, could it be done where it wouldn't include their particular acreage or their particular the properties they have the rights to? Does that make sense or not? Okay.
No, because two scenarios you can encounter there. Generally, whenever another company, because I have seen other companies come in and take over a lease, but if they buy an existing lease from an operator who's producing, then the existing lease terms stand. They simply assume the ownership of an existing lease, so nothing can be changed. If a lease were defaulted, then that unit has already been created and filed, that 640-acre unit the state requires for the types of wells you would drill in this area, then that operator would be bound by the terms of that unit that had already been established by the state.
Gotcha. Okay. I had mentioned when I was talking about the IRA side that an IRA would always be responsible for, it receives the income, but IRA is also responsible for any expenses. Someone was just asking, what kind of expenses are there associated with owning a mineral deed?
Zero.
Okay.
Zero expenses. I mentioned earlier, the only thing that comes from your revenue is a severance tax to the state.
Gotcha. Okay. One question a couple of people asked, I guess a number, kind of what's a typical investment amount when you're looking to buy into a mineral rights deed? They want to know obviously how Guardian makes its money. So that answering those two questions would cover quite a number of the ones that were here. But kind of what's a typical investment cost, and then how do you get paid?
So the first one, what's a typical investment? That really varies depending on an individual's financial situation. We've got people who will get started with us at first investment into this kind of thing at $50,000, which is the minimum for our company. We have other people whose first investment might be $500,000 or more, $750,000, $1 million. And so really just depends on your particular financial situation. The minimum, however, is 50,000 with our company anyways. And one thing I'll mention as well that I've not mentioned, because mineral deeds are conveyed through a physical deed recorded at the county, then they qualify as like-kind property in a like-kind exchange for real estate. And so a lot of our business is generated in that way as well. And so people who may hold physical real estate through Scott, through your company, through Advanta or their IRA, or just privately, if you liquidate that, if you sell that, but then put those funds back into some form of real estate, it doesn't have to be the same. That's a misconception. Some people think if I've got a rental property and I sell it, in order to do a like-kind exchange, I have to buy a rental property. Again, that's not true. It can be any form of real estate. You can sell a rental property and buy a mineral deed and do a 1031 like-kind exchange. And the IRS considers mineral deeds, quote unquote, real property for the purpose of a like-kind exchange. And so our investment dollars can really vary because a lot of our business is 1031 business. So it can depend on what the sale of a property is that someone is doing. But for retail purchases, got people who are just doing cash or making a purchase with their IRA, our minimum is 50,000. And so a lot of those people will start in that $50,000 to $100,000 range most often. And then second question.
They have to be okay. Yeah, I'm sorry. You actually I'll let you go on. Yeah. How do you all make, I guess, your money was the second part of that question, right? I'm sorry.
Yeah. The second question, the way that we make money is we essentially are flipping properties. We buy properties at a particular dollar. We'll add a percentage dollar amount on that. We'll mark it up a little bit and sell to clients. We have no ongoing fees, no ongoing management fees, nothing that comes from your revenue on an ongoing basis. It is a one-time transaction on our part. As far as how we make money is we simply buy properties and sell them at a marked up value.
Great. So yeah, so it's not really, there's not really somebody asking about the actual performance of Guardian. It's really not your performance. It's gonna be the performance of the operator on the and obviously what's underneath in your property.
Yeah, and we can show if anyone wants to look at historically how the properties have done that we've sold. We're happy to show some of that history. But what we aim for as a company is generally to show somewhere in the window of a 25 to 35% annual return rate. Depending, again, it's going to depend on the property, but our goal is always to see 25 to 35% as an annual return rate. And we 9 times out of 10, unless there are extenuating circumstances, again, bottom falling out of the market or something like that, one of the extremes that we talked about before, we almost always hit what we were anticipating or better.
Okay. And I'm assuming that because you're just buying a deed, there is no requirement that someone has to be an accredited investor. Is that correct? Okay.
Correct. This is not a syndication or a security. It's simply a real estate transaction, essentially. You are not required to be accredited, no.
Gotcha. Yeah, and someone asked again, does an IRA invest in a fund, a property LLC? Again, with your IRA, you could do this investment through an LLC if you wanted to, but you could also just buy the mineral rights deed directly in the name of the IRA. So there's no requirement that you're setting up a separate LLC, and you're certainly not investing into a fund. Getting back to the tax question, someone asked you, with depreciation, there's depreciation recapture. Is there recapture of the depletion allowance if you were to sell the property?
I can't answer that question, honestly. I've never been asked that before. I've done this and worked with IRA companies as well for over, like I said, well over a decade, and I've never been asked that question. Yeah. We would have to ask a tax professional, but whoever has that question, if you'll shoot me an email at my email address there, jflores@guardianroyalties.com. If you'll shoot me an email with that question, our accounting firm that we use is specializes, one of the largest oil and gas specialty accounting firms in the country. Oil and gas tax law is a very niche area of tax law, and I can get that question answered for you, but I can't answer that off the top of my head.
Okay. Yeah, great question. Just a few more, we'll wrap up here. I'm assuming an owner, if you're buying and selling the deed to an investor, that investor could, in theory, sell that deed to someone else if they wish, correct?
Yeah, yeah,
Okay.
absolutely. I get that question often too. What if I want to sell the deed down the road? You certainly can do that. You own the deed just like you own the deed to your home, and there are multiple avenues through which you can do that. Um, those being number one, and what I would primarily recommend is that you come back to us. We obviously have a book of business of oil and gas investors, people interested in this kind of thing that we could market it to. We'll help you also at that point give a valuation to the property. Secondly, there are multiple oil and gas multiple online forums, if you will, like an eBay or a Craigslist of sorts, online specifically for oil and gas assets where you can market yourself. So there are options there. Yes, you can sell it.
Okay. Two more questions. So, did you have to renegotiate the leases with the operators? Is that something that the mineral rights owner has to do, or how is that handled?
Great question. Leases remain as long as there is production. All leases have a clause called held by production, HBP clause. As long as they have production, the lease stands. Now, if ever a new lease did need to be established on a property, then the operator doesn't have to go to every single mineral owner on the property, because there is something called executive rights, which generally maybe one person across a unit will hold the executive rights, and that individual, obviously they're a mineral deed owner, so they're going to want what's best for them, which will be best for everyone. But that person will negotiate with the new lease, with the operating company wanting the new lease.
Good. Yep. Yes. Again, so someone said a 1031 exchange would be easy to identify replacement property, correct? Or you would find the next.
Yeah, very easy. We always have multiple properties just shelved in inventory at various dollar amounts. And so whether someone wanted to do the totality of their 1031, if somebody had $1 million sale and they wanted to do all million into royalties, we can accommodate that. If someone had $1 million sale and they had found a brick and mortar property that they wanted to place the majority of the funds in, say $900,000 property, they've got $100,000 left over, we call it the boot, we could accommodate that down to the penny, so that there's nothing in your 1031 exchange that can't be captured, saving you from having to pay capital gains.
Good. Yeah. And a question again, someone asked, how is the $50,000? I guess someone's making a $50,000 investment. How is it invested by Guardian? Again, it's not. Guardian isn't investing your money. You are buying a mineral rights deed from Guardian, who is selling the deed. So it's not relying upon Guardian to then invest those funds for you. And then I guess we'll wrap up with the last question, or unless you have thoughts on that really quick.
Yeah, I just wanted to say, think of it for everyone. Think of it as buying land. I'm not putting you into a fund that owns the land. I'm selling you the deed to the land. Now you own it.
Yep. And last question. Yeah.
Just like real estate.
Yep. How can a prospective investor, someone review available units? You mentioned, I guess there are online forums. I'm assuming they could reach out to you as well for property and acreage that is available. Yeah,
if anyone's interested in looking at a property, seeing what those look like, diving into further details on specific properties, feel free to reach out to me at either my phone number or email that are below here. That phone number is my cell. I work from a cell phone. I never use my desk phone. And so you're welcome to text me there or call, or you can also shoot me an email there at Guardian Royalties. Also, we have some materials as well that give explanation as to the function of oil and gas royalties, how that they work, get into some greater detail. If you reach out to me, I can provide some of that to you as well.
Great information for our guests. Maybe we'll love to have you back and maybe dive a little bit deeper into this in the coming months. So any final thoughts?
I just appreciate your time, Scott. And appreciate you giving me the opportunity to be here today, and hopefully we can do this again down the road.
Again, yeah, again, thank you very much for your time. Thanks everyone for listening live, or if you're listening to the recording, hopefully you can reach out to Jonathan with any questions that you have about the mineral rights deeds and what he covered today. If you have questions on the IRA side, please don't hesitate to reach out to me. My contact information is here. If you have questions about the IRA, more than happy to have that discussion with you. So again, thanks everybody for attending, and we look forward to speaking with you.